Welcome back to Cool Trade University. This is Gene Guarino. We're going to continue on with our stock market terms and definitions. This is an introduction to the terms and definitions, not an exhaustive training. So if you catch everything I say, terrific. If not, feel free to listen to it a number of times. But as an introduction, what I want to share with you now is Bollinger Bands. When we say Bollinger Bands, it's a trading limit set at 2 standard deviations above and below the moving average of a security. Traders look to sell near the top of the band and buy near the bottom. This was developed by John Bollinger, and Bollinger Bands, trademarked, are volatility bands placed above and below a moving average. Volatility is based on the standard deviation, which changes as volatility increases and decreases. The bands automatically widen when volatility increases and narrow when the volatility decreases. This dynamic nature of the Bollinger Band also means they can be used on different securities with the standard settings. Now, the formula that you see on the screen is laid out. It's actually fairly clear as you read through that, and we're just going to discuss it because it consists of a middle band with 2 outer bands. That's what the Bollinger Band looks like, and that's what it does. There's a middle band with 2 outer bands. The middle band is based on a simple moving average that is usually set at 20 periods. A simple moving average is used because the standard deviation formula also uses a simple moving average. The look-back period for the standard deviation is the same as the simple moving average. The outer bands are usually set 2 standard deviations above and below the middle band. Bollinger Bands reflect direction with the 20-period SMA and volatility with the upper and lower bands. They can be used to determine if prices are relatively high or low. Now, according to Bollinger, the bands should contain 88 to 89% of price action, which makes a move outside the bands significant. Technically, prices are relatively high when above the upper band and relatively low when they're below the lower band. However, relatively high should not be regarded as bearish or as a sell signal. Likewise, relatively low should not be considered as bullish or as a buy signal. Prices are high or low for a reason. As with other indicators, Bollinger Bands are not meant to be used as a standalone tool. You should combine Bollinger Bands with basic trend analysis and other indicators for confirmation. Bollinger Bands, this introduction to it right here, gives you an idea of where they came from and what they're used for. With Cool Trade University and these market terms and definitions, we're here to introduce these to you. Thank you, and welcome right back to Cool Trade University.